There is something about silver that almost nobody on the financial channels will explain to you plainly, and it is the single most important thing you can understand as an owner of this metal right now. Silver is a small market. It is a thin market, and a thin market does not move the way a big, deep, crowded market moves. It sits still and sits still and sits still until it does not, and when it finally goes, it does not walk, it runs. If you are holding silver right now, or thinking about it, I need you to hear this clearly because it cuts both ways. That same thinness that makes silver feel like it is going nowhere for months is exactly what can make it travel farther and faster than anything you own, in either direction, once the momentum takes hold. That is not a promise about a price, it is the character of the market itself. And by the end of this, I want you to understand that character so well that the next move, whichever way it breaks, does not shock you the way it is going to shock almost everyone else. Let me give you the one fact that sets the whole story up, and I will give it to you right now, not 20 minutes from now. Silver is one of the smallest major markets in the world of money. Compared to the ocean of dollars sitting in stocks, in bonds, in real estate, the entire pool of investment silver is a puddle. And here is what that means in practice. It takes only a modest wave of buyers or a modest wave of sellers to move a puddle in a way that would not even ripple an ocean. The big players know this. It is precisely why silver has a reputation for being violent. It is not emotional, it is structural. Now, let me take you back, because this has happened before, and the people who lived through it never forgot it. Go back to the end of the 1970s. For most of that decade, silver had been the quiet cousin. Gold got the headlines. Silver mostly sat in coin shops and industrial supply rooms, ignored. And then, in the space of a few short months heading into the very start of 1980, silver did something that still does not look real on a chart. It went nearly straight up. It multiplied several times over in a matter of months and rammed its head into a ceiling near $50 an ounce. I want you to feel what that was like from the inside, not as a number on a screen, but as a real thing happening to real people. Coin shops that had been sleepy for years suddenly had lines out the door. Ordinary families were pulling grandmother's silverware out of the cabinet, the forks and the trays and the tea sets, and carrying them in shopping bags to be weighed and sold. Refiners could not keep up. The physical metal could not move fast enough to match the frenzy of the paper. That is what a thin market looks like when it finally travels. It is not orderly. It is a stampede through a narrow door. And here is the part one I want you to hold on to, because it is the whole thesis of this video. Silver did not do that because it was a big, important, widely owned asset. It did the opposite. It did that precisely because it was small. A market that size cannot absorb a rush of real buying gracefully. There is not enough of it to go around at the old price, so the price is the only thing that can move, and it moves with a violence that a larger market physically cannot produce. The very thing that makes silver look like a sleepy nothing for years is the thing that makes it explosive when it wakes up. Now, the honest other side. That 1980 spike did not last, and I would be doing you a disservice not to say so plainly. It hit that ceiling near 50, and then it came crashing back down, and a lot of people who bought at the very top, in the panic of the crowd, got hurt badly. So this is not a fairy tale about easy money. It is a lesson about character. The move up was violent because the market is thin. The move down was violent for the exact same reason. Thinness is not a direction, it is an amplifier. It makes everything bigger, both the part you want and the part you do not. And I want you to notice who tends to get hurt in these episodes, because the financial media never frames it this way. It is not usually the person who quietly owned a stack of real metal and could sit through the swings. It is the person who was leveraged, who borrowed to chase the move, who was in a paper position where the rules could be changed on them mid-game. When a thin market runs, the exchanges and the desks that clear these trades have every incentive to protect themselves, and they can and do change the terms. We have watched in more recent years margin requirements get hiked in the middle of a silver run, and the price fall sharply in a matter of days. Not because anything fundamental about silver changed, but because the cost of holding a leveraged bet suddenly changed. That is a paper problem. The metal in your hand does not get a margin call. So let me pull this straight back onto you and your retirement, because this is where it stops being a history lesson and starts being personal. If you are a saver in your late 50s, your 60s, your 70s, with $100,000 or more sitting in a 401k or an IRA, the thinness of silver is the most important thing you can understand about how to own it. It means you never, ever want to be in the position of the leveraged speculator who can be forced out at the worst moment. You want to be the quiet stacker who owns the real thing and can sit still while the market throws its tantrum. Because the tantrum is coming in one direction or another, and only one of those two people survives it comfortably. And that brings me to something that most people in your position have never been told is even possible. And it is exactly the kind of thing the big institutions would rather you not think too hard about. You already know that the largest, most sophisticated buyers on Earth, the central banks, have been accumulating gold at a record pace, buying more than 1,000 tons a year for 3 straight years, roughly double what they bought in the decade before. They are not doing that for fun. They are protecting themselves. Now here is the part almost no one tells the ordinary retiree. There is a perfectly legal, well-established way for you to do the very same thing inside the retirement account you already have. You can move a portion of that 401k or IRA into physical gold and physical silver, real metal, without cashing out, without triggering taxes, without early withdrawal penalties. It is called a self-directed precious metals IRA, and it has existed for years. This is not some exotic thing reserved for insiders and the wealthy. If you have $100,000 or more in any retirement account, this is for you as much as anyone. If you want to understand exactly how it works, I have put together a free guide that walks through it step by step. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. It costs you nothing, and it will make you far harder to shake out when the noise starts. Now let me bring this all the way up to the present, and let me do it carefully. Silver in recent times has done exactly what a thin market does. It ran up to a genuine high, and then it went through a sharp, deep correction, a real gut check of a pullback, and it fell all the way back toward the area it had originally broken out from. Chart people call that a return to the launch pad, and it is one of the most testing things an owner can sit through, because it feels like the whole story was a lie. It was not a lie. It was thinness doing what thinness does. The very same amplifier that carried it up carried it back down. And here is the tell that almost nobody points out to you, the relational fact that matters more than any single price. Through much of that heavy swinging, gold barely moved. Gold sat there, comparatively steady, almost bored, while silver did all the violent work. Think about what that actually tells you. When silver falls hard while gold holds its ground, silver has just gotten cheaper relative to gold than it already was. The gap between them widened. And a wide gap between silver and gold has historically been one of the more reliable signs that silver is the cheaper, more coiled of the two. That is not a prediction. It is a measurement. And it is a measurement the financial media almost never puts in front of you, because a frightened silver holder dumping metal into a dip is a paying customer for the trading desks, and calm, informed holders are not. Let me re-hook you here, because this is the part that actually changes how you should think about the next move. Everyone is staring at the price, up and down, trying to guess the tick. That is the wrong thing to watch. Watch the structure underneath the price. And underneath silver's price is something that has been quietly grinding away for years, something that does not care what the screen printed this morning. The world has been running a structural silver deficit. Year after year, the amount of silver the world uses has outrun the amount the world digs up. And this is not the kind of demand that comes and goes with a headline. Here is why that deficit is so stubborn, and it is one of my favorite true facts about this metal, because once you understand it, you can never unsee it. Gold is hoarded. Almost every ounce of gold ever mined still exists, sitting in a vault or a coin or a ring somewhere, and it can come back to the market if the price is right. Silver is different. A huge and growing share of silver gets used, industrially, in tiny amounts. There are small quantities of it in solar panels, in electronics, in the electrical guts of modern life, dispersed a fraction of a gram at a time, and most of that is simply too small and too scattered to be worth recovering. In the plainest terms, gold is hoarded and silver is burned. It is consumed and gone. So while gold's above-ground pile keeps growing, silver's keeps getting drawn down to cover the shortfall. That is the coiled spring underneath the puddle. Now put the two ideas together, because this is where the thesis of this whole video snaps into focus. You have a market that is structurally thin, small enough that a modest rush of buyers can move it violently. And you have a structural shortage sitting underneath it, years of the world using more than it produces, above ground stockpiles being quietly drawn down. A thin market with a shortage underneath it is a very particular kind of coiled spring. It can stay quiet far longer than you would think possible, and then it can travel farther and faster than almost anyone believes, once it finally moves, because there simply is not enough metal to satisfy a rush of real buying at the old price. I have to be honest with you about the other force in the room right now, because it is real and it explains a lot of the recent pain. We have a new chairman at the Federal Reserve, and the market expected him to be gentle, to cut rates, to make life easy for assets like silver. Instead, his posture has come across as notably tougher on inflation than people bargained for, and that hawkish surprise is a big part of why gold and silver went through the correction they did. I tell you that not to scare you, but because you deserve the honest picture. A tougher Fed is a genuine headwind, and it can keep a lid on things longer than the impatient crowd wants. But notice something. None of that changes the thinness. None of it changes the deficit. Those are structural, and they are still sitting there underneath, patient, whatever the Fed says at its next meeting. So, what does an ordinary, sensible person do with all of this? Not a speculator, not a gambler, but you, someone who has worked and saved and wants to protect what you built. First, you own the real thing, not a paper promise. In a thin market, the difference between holding metal and holding a claim on metal is the difference between sitting calmly and being someone else's exit liquidity. Second, you size it so that a shakeout can never force your hand. The people who got destroyed in that 1980 episode were not destroyed by silver. They were destroyed by being too big, too leveraged, too exposed to survive the swing. If you own an amount you can hold through a violent pullback without losing sleep or being forced to sell, the volatility stops being your enemy and starts being the price of admission. And third, you do not sell into the shakeout. The whole game of a thin, violent market is to frighten the weak hand into handing his metal to the patient one at the bottom. Do not be the weak hand. Now, here is the part one I have been building toward, and I want you to really sit with it, because it is the difference between the people who look back on these moments with satisfaction and the people who look back with regret. The largest, most informed buyers in the world are already positioned. The central banks are quietly accumulating. The people who understand the thinness and the deficit are already holding their metal, calmly, through the noise. The mainstream has not caught on. The financial media is not running silver as the top story. Your neighbors are not talking about it at the barbecue. There is no line out the door at the coin shop. Not yet. And that, right there, is the signal. Because by the time silver is the obvious trade, by the time it leads the news and every advisor is recommending it and the lines are back out the door, the easy part of the move will already be behind us. Thin markets do their most spectacular traveling before the crowd arrives, not after. That is the whole point of understanding this now, while it still feels early and uncertain and quiet. Nobody is going to send you an invitation. Nobody is going to call you the week before the move and tell you to get positioned. It does not work that way. It never has. The recognition comes to the crowd last, always. And by then, the thin door everyone is trying to rush through is exactly as narrow as it was in 1980, when the metal could not move fast enough to match the frenzy. Being early does not feel like being smart. It feels like being lonely and a little unsure. That is what early is supposed to feel like. And that is exactly why I want to make you an offer, for those of you who have stayed with me all the way to here, because you are the ones who actually think about this stuff, instead of just reacting to headlines. If you have $100,000 or more in a 401k or an IRA, I would like to give you a free, no-obligation, one-on-one educational web conference. It is not a sales pitch, and it is not a seminar with 100 strangers. It is a real conversation about your situation, how a self-directed precious metals IRA actually works, and whether moving a portion of your retirement into physical gold and silver makes sense for you. And here is the honest why now, with no fake countdown clock attached to it. The right time to make a calm, clear-headed decision about protection is exactly when nothing feels urgent, when the crowd is bored and the price is quiet, because that is when you can think instead of react. Once it is obvious and the lines are out the door, the calm is gone, and so is the easy part of the move. To take me up on it, if you are watching on your television, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com and mention that you watched this all the way to the end. Let me leave you where we started, because I want this to close cleanly in your mind. Silver's next move could shock everyone, and now you know why. It is not because silver is magic. It is because silver is thin, and a thin market with a shortage underneath it sits still and sits still and sits still until it does not. And then it travels far and fast in whatever direction it finally chooses. None of this is a guarantee, and none of it is personal financial advice. The volatility is real in both directions, and I would be lying to you if I promised you a price or a date, because nobody honest can. This is a case built on the character of the market and the history of how it behaves, not a promise. But the people who understood that character in 1980 were not shocked when the metal ran, and they were not shocked when it fell. They simply understood what they owned. Own the real thing, size it so you can sit still, and refuse to be the weak hand at the bottom. Do that, and whatever silver does next, it will not shock you. It will only confirm what you already understood.